let's get started. As I said before, my name is Tim Hart. I'm from one of the directors from Private Mortgages Australia, and I really just want to talk to you a little bit more about what we do at Private Mortgages Australia, but more importantly, how we work with referrers and how we make sure we look after referrers. So I would say probably 90 to 95% of our business comes from referrers. So we're very much interested in hearing your feedback and seeing what you guys think, and making sure that it's going to be a win, not just for you guys as the referrers, but also for your clients. So look, let's get started. You'll see that here is a list of our products and what we do. So the first thing you'll notice is that we only do business finance. So we can't do someone who wants a loan to go overseas on holiday or anything like that. It has to be for a business purpose. So we actually do not only first mortgages, we do second mortgages. We also do caveat second mortgages. So with our first mortgage products, we've got interest rates there from anything from 1% to 2.5%. That's PCM, so per calendar month, not per annum. So for us, it's really designed to be short-term funding. Someone needs some funding quickly, but also for a short period of time. So that's why we all quote in per calendar month. First mortgages, anything from 2 months to 36 months. So we're not like a normal bank that sort of looks at 25 and 30-year-old loans. It's very much in that short-term time frame. Amounts anything from 50,000 to 2 million. Second mortgages do carry a little bit more risk. That's why the interest rate is a little bit higher in those products. We'll do 2 to 12 months and loan amounts from 50,000 up to 1 million. And the final one is caveat. So this is where we don't even have time to register our mortgage. The client literally needs funds within a couple of days. That's when the rate's a little bit more expensive. You're paying for that speed. That's where the rates are that 3 to 5%, and terms of only sort of 2 to 6 months. So it's that really someone just needs money urgently just for a very, very brief period of time. And those ones between 50,000 and 500,000. So let's look at the next thing. The most common question we get asked, I suppose, is a lot around how much would you lend my client, or how much would you lend me as a borrower. Now, what we do, we break our categories into 4 postcode categories, and this is based on the Genworth financial postcode category. So if you don't know Genworth Financial, one of the mortgage insurers in Australia, and they break the categories usually based around location and population size. So for category 1, that's most properties. So anything that's within, say, 40 to 50 Ks of a major city like Melbourne, Sydney, Brisbane, Gold Coast, that sort of thing. Most of those are category 1. Category 2 is when you get a little bit further out. That's your major regional towns usually. And then category 3, once again, usually out in the country, but usually smaller populations, smaller towns. And then category 4, affectionately known as whoop whoop. So that's a property that's in the middle of nowhere. These are really small towns. So you'll notice that we lend less and less on a property that's further out. And really it's just around the buoyancy of the market. So how hard is it going to be for that client to be able to sell that property if they needed to pay out the loan? So obviously we'll lend a lot more in something that's got a lot more liquid market, like a 3-bedroom house in suburbia. Now, the other thing you'll notice, we've got a maximum column. So with private lending, we're very different from a bank. Okay, there's no real hard and fast rules a lot of the time. We're very flexible. That's what private lending is all about. You come to us when you need a bit of flexibility, maybe around the time frame you need the money, but maybe there's something to do with the scenario that's a little bit outside of the norm. So we actually have discretion to go above these limits. So for residential, for instance, we can actually go up to 80%. Commercial, we can go up to 80%, even though we say we tap out at, say, 70. Now that's provided there's some justification for it. Okay, it still has to be commercially justified. And one of the big things we look at is, what's the exit strategy? How is this client actually going to pay the money back? So if we can see, look, maybe they've sold the property. We had something like this recently. They'd already sold the property. It was an unconditional contract of sale, but they couldn't wait the 2 months until settlement. They needed some funding now. Okay, so those sort of circumstances, we can start pushing the envelope a little bit higher to make sure that it's going to be give the client what they need. Okay, the next big question we get asked is, what are the fees and charges? Obviously, we've gone through the interest, but what are the other costs that are associated with the loan? So you can see here what we charge is a very small upfront assessment fee. Okay, so this just covers our cost of doing all the searches, title searches, internal valuations, bankruptcy checks, all the little checks that we need to do in-house, and we base that fee based on complexity. So if it's one security property, really basic loan, it's usually $550, and that's where most of our assessment fees are at. You start getting up to 2 and 3 and more security properties, that's when typically the assessment fee will increase, just because the sheer number of title searches and searches that we need to do, and how complex the transaction is. Any evaluation, if required, not always required, but if we do require evaluation, it's done at cost. So there's no margin. We even allow the client, they can pay the valuer direct as long as we're instructing them. The other thing is any legal costs is all done at cost. And the last thing we have, the only other fee we have, is a referral fee. Now, we've had some feedback from one of our brokers recently. This is literally 2 weeks ago, and we've overhauled our referral program. And PMA has now become channel agnostic. Now, if you don't know what that means, join the club. I only found out a couple of weeks ago. And basically what that means is that a client who comes to us they're gonna pay the exact same fee if they come to us directly or through you as a referrer or a broker. Okay, so it just means that they know they're not paying any extra by coming through yourself. There's no advantage of coming to us directly. They're not going to get a cheaper approval fee. So what we've done now, we've now included a referral fee in our approval fee. So you can see, for instance, a $500,000 loan, anything between $500,000 and $1 million is going to be a 3% approval fee, and of that includes 1% for you as the referrer. Now, we never like to limit how much our referrals are going to make, because every deal, can take a little bit more time than others. So what we allow is we allow you to actually charge a service fee. Okay, so you can put into the indicative letter of offer a service fee, so it might be $500, $1,000, or you can specify an amount. So the other thing you could put in there is if you've mandated your client directly. So maybe you've mandated your client for, 1%, then we're happy to put that in as a service fee into the indicative letter of offer. Okay, so the only sort of rule we have around this is it must be disclosed up front. Okay, so we need to make sure that all the cards are on the table and the client knows exactly who's getting paid what, and it's done at the stage of the indicative letter of offer. Now, the next thing we've got is that referral fee is paid even if your client comes direct. Now, let me explain what that means, and this is something that I don't know any other lender in the marketplace that's doing this, but if you send us a client, then we see that as your client. And if that client comes back to us, because we do see a high level of repeat clients and repeat customers, if they come back to us directly, then we will actually pay you the referral fee still. Okay, so you don't need to do any work, and we've had this where we'll just contact the client, we'll contact the referrer and say, great, we've got some money for you, what account do you want the money in, same as last time. Unless the client has gone through another referrer to come to us, we'll make sure that you get paid that fee. So it's just a little thank you for an acknowledgement that they're your client, and you get paid that ongoing fee as they come back and do more and more business with us. The last thing we've implemented is a referrer rewards program. Now this is what it looks like. Now you may have seen it before, but we've actually slashed the milestones dramatically. So pretty much chopped them in half, and so you only need to settle $500,000 worth of loans with us, and automatically you're starting getting a reward. Now this is all in addition to your share of the approval fee and mandates and all that sort of thing. This is just an extra little bonus, a little thank you to thank those referrers that give us more business every year. So let's say you settled a loan for $1 million with Private Mortgages Australia. You'd get a $500 voucher. That could be from Myers or Dan Murphy's Flight Centre, but you'd also get the $500,000 milestone. Okay, so it's all cumulative. So if you settled a $3 million loan with us, you'd get a $2,500 voucher, $1,000, $500, and a $250 voucher all in one. Now that, as much as we've got the different gift cards there, they're just examples. If you particularly want a gift card from some other place, just let us know and we'll make that happen for you. Last thing to note, as soon as you hit that $3 million worth of milestones, we very much see you as a platinum referrer. So we give you a lifetime membership into what we've called the PMA's Platinum Playground, where in addition to this, you'll also get a $500 gift card every financial year, provided you get a minimum loan volume of $500,000. Okay, so this is to reward those what we call Category A referrers that are giving us multiple deals every year. Okay, so that's how we work with referrers. Now let's look a little bit about how we actually, what happens when you refer a loan. What's our loan processing look like? So the first step is that you either submit an application form, or we've also got a quick app form, a one-page quick app form. Now once again, this one-page quick app just came from an idea, a feedback that we got from one of our referrers, that they wanted the process to be simpler than easier than everyone else. So we've literally got a one-pager that you can give us the real high-level details of the deal, and that's enough for us to do our initial assessment and actually produce an indicative letter of offer. Okay, so you don't have to fill out the full application form for us to do that assessment. Now, of course, ultimately we will need an application form, but sometimes it's easier just to get the quick app form in, and then we can come back to you and say, yep, here's the LVR we're going to do, here's the fees, here's the rate, and then your client can make a decision if they want to move forward. So once we've issued the indicative letter of offer, and usually this can happen, you know, we've done this within an hour sometimes, but definitely within a 24-hour time period is very consistently we've been doing that. Once we get the indicative letter of offer signed and the assessment fee paid, that's when we then finalise our due diligence. So we'll do all the due diligence, we'll do all the searches that we need to do, and we'll then come back with the formal letter of offer. Upon acceptance of the letter of offer, we then obviously get the loan documents issued, and then very quickly we proceed to settlement. So it's quite a quick process that we need to go through. The only real hold-up is more we need to make sure we get any documentation that we request from the client into us as soon as possible. So let's go through qualifying a deal. So this, I just want to, I suppose, go through what we look at so you can see what we need to actually qualify a deal and the process that we go through. Now, the very first one is the loan non-coded? Okay, so at the very start I said we only do business lending. If mum and dad want to borrow 50 grand to renovate their own home, we can't do it, okay, because that's a coded loan. So let's look at what is a coded loan and what's a non-coded loan. So the first thing we look at is who is the borrower. So if it's a corporate borrower, so if the actual borrower is a company, so a client's buying a property in a company name, then that's automatically deemed to be non-coded, okay, nice and simple. If it's an individual borrower, if the purpose of the loan is for domestic purposes, then it's a coded loan and we can't help you. If more than 50% of the loan is for business purposes, then it's deemed to be non-coded. Okay, so just keep that in mind when you're looking at the purpose of the loan. The other thing we look at is what's the type of security. So if it's a commercial property, therefore it's a commercial loan, it's then deemed to be non-coded. If it's a residential property, then same again, it must be more than 50% of the funds must be for a business purpose. Okay. And now, if you've got you need any clarification of that, or you've got a particular scenario you're not too sure on, by all means, give us a call, and we're happy to let you know if it's going to be a coded or non-coded loan. So the next thing we look in our first filter is the interest rate, 1% per month. So our cheapest loan we'll ever do is 1% per month. So we need to, the client needs to accept that the interest rate is going to be 1% per month, or or 12% per annum. If they're not accepting of those rates, then let's not get started, okay? Because that's the cheapest it's ever going to be, and obviously it goes up from there depending on if it's a second mortgage or the LVR and the location and the like. Okay, so that's the next sort of check that we do. The third one we do is the postcode and loan to value ratio, or LVR. So we went through at the start there, we went through what loan to value ratios will do depending on the location or the postcode for that particular property. So we just want to make sure that that's in line. We're not trying to get a 90% loan on a property that's in Whoop Whoop in Category 4, okay? The next one we've got is the referrer service fee or mandate. Okay, so we just want to know from you as a referrer, do you want to charge a service fee or have you mandated the client? If you don't, that's fine. We'll just put nil on the indicative letter of offer, but that's something we just need to flesh up front. The fifth thing we look at, and probably the most important one, is actually the exit strategy. How does the client actually going to pay the loan back? Because we're all about creating a win-win scenario. We want to make it so that the client, at the end of the day, can repay the loan. Okay, that we don't want to set anyone up for failure. We want to make sure there's a realistic possibility of them either refinancing or cashing out, or they've got a settlement, or whatever the case may be. We want to make sure that they've got, if they've got a 3-month loan, that there's measures in place to repay it at the end of the 3 months. Now, one of the big things and where we get a lot of business from is actually serviceability is not required for us. Okay, because we're short-term lenders, we're more interested in the asset. So it's more of an asset lend for us. We don't really care about serviceability. Okay, now this is a big advantage that we have over the banks, that we're not required to look at that serviceability. Now, one of the bigger things because of that, or the reason we can do that, is let's say we've got a 6-month loan. Typically we'll make the loan prepaid, so that the interest payments are already paid for the borrower, so they literally just get the money from day one, and then they just have to pay us a big lump sum at the end of the 6-month period. There's no payments they need to make along the way. So that's why we don't really mind about serviceability. The next one is, why can't the client get bank finance? Okay, so if your client can get bank finance, do not use us. Very simple. We are going to be more expensive than a bank. Okay, we're going to be a lot quicker than a bank, a lot more flexible than a bank, but we're never going to be able to beat their interest rate. Okay, because there are a lot more boxes you need to tick for a bank. They're going to take 4 to 6 to 8 weeks to get a loan, and they're going to be a lot more stringent in their criteria. So we just want to understand up front, because we're going to find out anyway, why can't that client get bank finance, and just make sure it's something we can work with the client. And the last one as well, and very, very important, is when does the client need to settle? Okay, so it's very much, we see it as almost like a joint venture. We're working with your client to make sure that they get the goal that they need. Okay, so if they need to settle a property or a loan within a week, great, let's get that date up front, so we know we're all working towards the same date and the goal to make sure the client gets the money in time. All right, what I want to do just here, I just want to talk a little bit about a deal that we did recently, and it was a completion finance deal. So this is for a development loan where we come in at the end of the loan just to finish off the development. So the scenario was, it was the borrower bought a development site in Altona North in Melbourne, just over the Westgate Bridge there, and they were doing a 3 townhouse development. The build was 90% complete, but then they ran out of money. Okay, so they were trying to self-fund it, and they kind of got to a stage where they ran out of money. Now, the borrower was a company. Their experience was none. This is actually their first development deal. Now, a lot of you may know the banks are really tightening up in development, but even more particular if you have no experience in development, they're very, very hard to get finance from. Whereas for us, we don't mind. It's something we'll look at. Obviously, we do like experience, but for us, it's more about the property and the LVR as opposed to the experience of the person. The next one, the serviceability. They were self-employed and had no financials. Once again, the bank didn't like that. We got a valuation done. The valuation, as if complete, came in at $1.95 million. They already had a first mortgage in place of $520,000, and they had a build contract in there, a fixed price build contract of $650,000. They'd already self-funded $250,000, so there was a shortfall they needed to complete the construction of $400,000. The term of the loan was 2 months, so they were literally right at the end of the development. They already had 2 pre-sales lined up, but they just needed $400,000 for 2 months. So the exit strategy was the sale of two of the units, which they already had pre-sales for. So when we look at this deal and we put it through our first filter, we look at, is it non-coded? Yes, it's a company borrower, automatically deemed to be non-coded. Nice and easy. The next one, the borrower was happy to pay more than 1% a month. They were happy to pay a rate of 1.9% per month. So with our second mortgage facilities, those rates start at 1.5%. So they knew that the interest rate was going to be more than 1.5, and they were happy to pay 1.9. The postcode and loan to value ratio, the postcode was category 1 because it was in sort of 10 k's of Melbourne. Great location, and it was a less than 65% loan to value ratio. So that ticked that box for us as well. The referrer wanted to make 0.6 plus GST, so we made sure that was in there for them. The exit strategy was the sale of the units. They couldn't get bank finance for a myriad of reasons. They were self-employed, no financials, no experience, and probably one of the big ones is time frame. They couldn't wait for a bank to take, probably 2 months to actually get it. They needed it really quickly. They needed to settle as soon as possible. They actually had an outstanding invoice of 330 grand to the builder for work that had already been done. And the builder was threatening, basically, he's not going to do any more work until that invoice is paid. So they couldn't actually get the buildings finished until that builder had finished and got paid. So the solution was we came up with a $435,000 second mortgage. So that 435 included the approval fee and the prepaid loan term of 2 months. So that way they got their net $400,000 that they needed. The interest rate was 1.5% per month. It came with 2 months, and we also gave them 6 months worth of extensions. So if something happened and there was delay, like that happens in real life, delays happen, then they can just make 1 month extension payment to extend the facility. Okay, it doesn't just suddenly go into default. The approval fee for this one was 2.6, and included in that was 0.6 for our referrer. Now moving forward, this was on our old system. So on the new system, obviously the approval fee would have been more around that 3.5%, and 1% would have gone to the referrer. So let's have a look at the best way to sort of understand short-term lending, because a lot of people I see in the marketplace, they get really hung up on the interest rate. They look and go, wow, an interest rate of 1% per month, that's 12% per annum. But what we're really talking about is only a couple of months. And for me, the best way to look at the cost of a short-term loan is look at the total cost. Because someone might say, oh, look, we're only going to charge you an interest rate of 1% instead of 1.9, but their approval fee may have been 30 grand, okay? Or their legal fees may have been $10,000. The only way to compare them is to look at the total cost. So in this example, the interest for the 2 months was $16,530. The approval fee was just under 12.5, and the legal admins was $5,500. So the total cost of this loan for the 2 months was $34,471. It then becomes a much simpler equation and decision for the borrower to make. Does it make business sense to spend $34,000 to get this money? It makes it nice and easy to work out. So what we looked at, and this is what a lot of our clients look at, is we did a little rough feasibility for this client. These aren't the exact numbers, but this is what we roughly worked out. They had a gross realisation value for their development, once it's all complete, of $1.95 million. They had some costs. They purchased the land for $650. They had some stamp duty of $35. They had the build cost, which is $650. And we had some other costs in there, real estate agents, council fees, holding costs. Roughly, we estimated about $115,000. So all up, the gross profit for these clients was 500 grand. So doing this project, they're going to make a $500,000 profit. Now, if I look at that, I look at, does it make business sense to give away 7% of your profit, being the $34,000, to get the deal done? For me, that makes a lot of sense. I'm going to spend $34,000 every day to get back 500. Okay, and that's what the way I would look at a deal if I was borrowing money. If I'm going to borrow, let's say the cost was $34,000, but the benefit I was only going to make $30,000, then it kind of doesn't make sense. Where in this case, it's a no-brainer. 34 to make 500, nice and easy. So just when you're talking to your clients, I suppose steer them away from looking purely at the interest rate. Look at the total cost. That's where the true picture is. So let's look just a couple of the other types of lending that we sort of specialise in. The first one, bar none, is definitely urgent funding. So deals that need to be settled very quickly. Another one, asset lending. So we don't really care about serviceability. It's more about how many assets the client has and what that loan to value ratio is. Another one we're seeing a lot of now is ATO debts. You might be aware that I believe that as of the 1st of July, the ATO is actually planning on bringing in some rules around if there's an ATO debt outstanding, they're actually going to start hitting people's credit report, okay? Because they found that all the banks were lodging, defaults in people's credit report, and they were getting paid out, whereas the ATO was sort of being left second place because they didn't have anything on the person's credit report. So that's something we've done a lot of, is paying out ATO debt. So we can get in there, pay out the ATO debt, so the client's got a clear ATO portal, and that then allows them to maybe go and get refinanced from a more traditional lender. Another one we saw recently as well is refinancing caveat loans. So we had a client who took out a caveat loan that had a default interest rate, I believe it was around the 12% per month sort of rate. So where we actually came in and refinanced that loan at a much lower rate of around 2.5% per month. So we can do things like that. Another one we've done do a fair bit of is valuation, not contract price. Okay, so we're property investors ourselves. It's all about, for us, we believe in the real world that you can buy something under market value. You can buy it for $2 million and the valuation can legitimately come back at 2.5. So we're happy to lend on valuation rather than contract price. So you might have a client that's in that scenario. It might be you might have someone that's paying out a business partner. They might have an urgent business opportunity that they need funding urgently to take advantage of buying some stock at a discount or whatever it might be. Developers, I said we're happy to do construction finance. We really do specialise in completion finance, so sort of coming in at the right at the end of the development just to get it finished. And the last comment I want to make here is credit impaired. We don't really mind if the client has bad credit. Where the only time I suppose it comes into play is if the client's got really bad credit and their exit strategy is to refinance. That's when we really want to take a look at it, because we want to make sure that if they're trying to get refinanced, who are they getting refinanced from? Is their credit going to be an issue? But for us, not so much of an issue. Once again, it comes back to the asset and how much it's going to be. All right, guys, what I want to do, just to finish up here, just the last couple of slides, I just want to talk a little bit about sort of borrower beware. So just some of the other things that we see private lenders that are doing in the marketplace. The first one that we see is from rates. Okay, so what we will do as well is we are recording this. So if the sound has sort of dropped in and out a little bit, by all means you'll be able to get a copy of this so you can listen to it, or if you've got staff members or team members that you want to show it to, we will have a copy of that we've recorded. So just with the other lenders, we do see sometimes they have what we call from rates. So they'll say, hey guys, come and get a loan through us. We've got rates from 1%, okay, but there's no upper limit. And I've seen a lot of this where they'll say, oh, the rate's from 1%, and of course the client is expecting the rate to come in at 1% or around 1%, and then all of a sudden, next thing you know, right before they need to settle, they come back and go, yep, we've got an offer, but it's at 3% per month or 6% per month. There's no upper limit as to what the rate might be. Okay, so for us, we have that defined section. If you come to us with a first mortgage, it's going to be between 1 and 2.5. And as soon as you give us the scenario, we're going to come back to you very quickly with what the indicative rate is. Okay, so it's just giving a lot of transparency around setting expectations for your clients. So just be careful of from rates. Another big one that I really can't stand is big upfront fees before the final offer. I saw one the other day from a lender I won't mention, but it was an $18,000 upfront fee that the client had to pay. Now part of that was for evaluation, but part of that was just fees for the sake of fees' sake. And they charged an $18,000 fee before they even had the final offer, knowing what the interest rate's going to be. And what happened is they did the valuation. They did the valuation for a forced sale, so it came back really, really low. And they said, yep, well, your valuation doesn't stack up. We're not going to do the deal. Thanks for the $18,000. Come again. Like, now, obviously that lender doesn't really care about repeat customers, but that's just something to keep an eye out for. Okay, for us, we pretty much don't charge anything up front other than a small assessment fee, and any costs are all done, any fees are all done at cost. The other big one I see a lot of people getting caught is these 24-hour loans. There are very, very few lenders in Australia that can do 24-hour loans. But what the marketing thing that they're doing is they're saying, we do 24-hour loans. You then get into their system and 24 hours later they say, oh, look, we just need another 24 hours. Oh, and actually there's a delay. We need another 24 hours. So if someone says they can do a 24-hour loan, I'd ask them how many loans they've ever done that have actually settled in 24 hours. The answer is probably going to be one or none. At PMA, we can't do 24 hours, and we don't purport to do it. For us, our quickest loan is typically around 3 days, and that's realistically from getting the application in, getting the loan documents done, and actually settling the loan. There's a lot of work to be done, yeah, 24-hour loans, it's more about getting you into the system than it is actually settling the loans. The other one we get, I've touched on before, is very expensive valuations for forced sale. So the first thing is, one, the lender's making a profit on the valuation, which I think is ridiculous, and the second one is the purpose of the loan, the purpose of the valuation is not for mortgagee purposes or market value. They've done it for forced sale. Okay, so basically they're telling the valuer, give us a really, really low valuation. So keep an eye out for that. The last thing we see is cancellation fees. So for Private Mortgages Australia, in our indicative letter of offer, there's no cancellation fee. The only thing your client will ever lose is that assessment fee, and that's it. Whereas we see a lot of the time that these lenders have in their indicative letter of offer is a cancellation fee. So if your client pulls out, or even if the lender pulls out, they then charge you, it might be a couple of % fee. And if you don't pay the fee, they've then got charging clauses in there that they'll then caveat all the client's property and charge their PPSR register, and basically they hold the client's properties to ransom until they get their fee paid. So just be very careful about charging clauses and cancellation fees in indicative letter of offer. So for us, and what I want to talk to you about, just the last slide here is the PMA way. Okay, we're all about cleaner loans and better results. So for us, we have a low upfront assessment fee that is fixed. We have no charging clauses in our indicative letter of offer. We have no cancellation fees in our indicative letter of offer. All valuations are done at cost, and we also do them for a reasonable value. So we'll usually do it for mortgagee purposes. Legal fees are done at cost. We have capped interest rate ranges. The other thing we do is, if a client needs an extension payment, and let's say they extend for 1 month, we will actually rebate them any unused interest on an extension payment. So if they extend for 1 month and they decide to settle maybe 2 weeks later, we'll actually rebate them the 2 weeks that they didn't use. So they're only paying for what they use. The only time we won't rebate interest is for the prepaid loan term. Okay, so if they say, hey, we want the loan for 3 months, then they have to pay for that 3 months, even if they win the lotto the next day and pay it back. The reason we do that is that it's not worth us doing the loan if it's not for that prepaid loan term for that 3 months. The next thing we've done is we've spent a ridiculous amount of money and time building our own custom-built software. So we've got our own processing software that allows us to do faster deal processing times. So just because at the end of the day, private lending and why clients come to us, it's all about speed. Okay, it's yes, we're happy to pay your fees and your rates, provided you can get the money to my client quickly. So that's for us is an ongoing commitment to making sure that we've got the fastest processing times in the marketplace. And all these things, they translate into a very high level of repeat customers. Okay, we have people coming back to us time and time again because they understand it and they love our service and the transparency that we operate in. So it's all about a win-win approach to lending, not just for the lender but also for the borrower and our referrers as well. Because ultimately, if you're a referrer, you want to send your client to someone that's going to look after your client. Okay, you don't want a client that's going to come back and say, "Why did you send me to them?" You want them to say, "Thank you. They helped me out and they got the solution that I was after." Now, you may have seen in some publications, Australian Broker and the Advisor, that we've just taken on a new senior relationship manager. Now, this is Royce. And he comes in with an absolute wealth of experience in banking. So he's got 16 years experience in banking. He's experienced in asset financing, corporate banking, and also private lending. So perfect for the sort of the field that we're in. And the big benefit as well is that he's actually fluent in 4 languages. So English, Mandarin, Cantonese, and Hokkien. Never even heard of Hokkien before, but he's fluent in it. So you know, especially in Australia, a very multicultural society, it's always nice to have someone that can speak those different languages. So if you do have a client that perhaps English isn't their first language, then yeah, we can really help, because we're all about speaking directly with your client, and it's not uncommon for Royce to come in and talk with you and your client directly to make sure that we're all on the same page, and we're going to get to the finish line and get you the client the solution they need. So guys, if you've got a particular scenario, please contact Royce. His phone number is there, and also he's got his email. So any loan scenario, anything you want to do, he's available right now. So any scenario, please give him a call directly, and he'll be able to assist. The last thing before we finish up is feedback. We want it. Okay, all the changes that we've made to our referrer programs, it's all driven by feedback we get from you guys, from our referrers. Okay, so we want to hear from you. If there's something you want to see changed or something you think we can do better, tell us. We want to know about it, because we want to keep improving. We want to be the best private lender in the marketplace. So yeah, any feedback you have, we really do welcome it. Please drop me a line at tim@privatemortgagesaustralia.com.au. We look forward to hearing from you. So guys, look, that's it from us. As I said, we will make we're going to make this presentation available on our website. I do apologise for the sound. I understand it has been dropping out a little bit, but yeah, in the recording it should be there in crystal clear sound. Yeah, we'll send you out the slides so you can have a bit of a look, and yeah, hope to do some business with you soon. Thanks guys, have a good day, and talk to you soon. Cheers.